Hi there. Registering for VAT in construction can affect how you invoice customers, especially where the domestic reverse charge applies.
Your trade business has been growing steadily. You've hired help, taken on larger contracts, and finally crossed that £90,000 turnover threshold. You are now officially registered for VAT in the UK. You complete your first major project under this new status and send off an invoice for £10,000. Under normal rules, you'd expect to see £12,000 land in your bank account, your 10 grand plus £2,000 in VAT that you'd hold on to until your quarterly tax return. But when the contractor pays you, the transfer is for exactly £10,000. That £2,000 in VAT is entirely missing. You haven't been shortchanged. You've just encountered the domestic reverse charge, a specific set of tax rules applied strictly to the UK construction industry. This shows exactly what happens to that money. Normally, the customer pays VAT to the supplier, but under the reverse charge, the main payment flows to you, while the VAT portion detours directly to HMRC. It bypasses your bank account completely. The government designed this to prevent missing trade or fraud, where a subcontractor collects the VAT and then vanishes before paying it to the tax office. While this mechanism secures tax revenue for the government, it removes a temporary cash cushion from your accounts, meaning you must now operate strictly on your net income from the day you register. This rule doesn't apply to every single job you take on. To trigger the domestic reverse charge, a transaction has to pass a strict 4-part test. Let's look at the exact conditions an invoice must meet to pass through these filters. First, both you and your customer must be registered for UK VAT. Second, the payment for the work must be reportable under the Construction Industry Scheme, or CIS. You have to be precise. This excerpt from HMRC's technical guidance shows the strict boundaries of the CIS. The bulleted lists define exactly which services fall inside the reverse charge, like laying foundations or installing heating systems, and which ones are excluded. To pass these last two gates, the work must be subject to the standard 20% or reduced 5% VAT rate. Zero-rated housing projects don't count. And finally, your customer cannot be the ultimate end user of the property. They have to be selling those construction services on to someone else. There is a crucial detail here that often catches newly registered tradespeople off guard. Even though you aren't collecting physical VAT on these invoices, HMRC still considers them taxable supplies. Their full net value still counts toward your £90,000 mandatory VAT registration limit. If an invoice fails even one of those 4 conditions, you revert to normal VAT rules and charge the 20% yourself. Failing to categorize a job correctly leads straight to HMRC penalties, so you have to evaluate every single contract. Once you determine a job actually passes the 4-part test, you have to format your invoice to match the law. Take a look at the sample invoice. Notice that the total amount due is only the £10,000 net value of your work. The 20% VAT is clearly calculated and displayed for the record, but it is explicitly not added to the final payable total. To make this document legally compliant, it also has to include a specific phrase. You must add a specific legal disclaimer stating the buyer is responsible for handling the tax with HMRC. When you hand this over to the main contractor, they use it to account for that £2,000 directly on their own VAT return. They record it as if they had made the supply themselves and simultaneously claim it back as a purchase. By issuing this exact document, you remove yourself from the VAT chain for this job. You handle zero tax money, and the entire compliance burden shifts upward to the contractor. While that saves you administrative headaches, it introduces an operational problem. You can no longer temporarily hold that VAT cash in your business account to float your day-to-day business expenses. Filing your first VAT return, you enter large sales figures into Box 6. Because you didn't collect the tax, Box 1, your output tax, sits at 0. As receipts for materials and fuel pile up, that out-of-pocket tax drops into Box 4 as input tax. Because you are paying out VAT on your costs but collecting 0 on your sales, HMRC actually owes your money. In accounting terms, you have officially become a repayment trader. If you wait for the standard quarterly VAT return, those material costs stay trapped at the tax office for months. To fix this, log into your HMRC account online and switch your business from quarterly to monthly VAT returns. Taking this administrative step forces HMRC to process your paperwork and refund your material costs 12 times a year instead of 4, which reduces the time your capital stays tied up in tax returns. Keep in mind that your workload might be a mix. If you take on a private extension for a homeowner, a direct-to-consumer job, the reverse charge doesn't apply. You will charge them the 20% VAT and collect it yourself. Because the line between an end user and an intermediary can get complicated, Atlas Tax Advisors recommends having a professional review your specific contract structures. The domestic reverse charge rules completely remove the temporary cash float that many growing construction trades rely on. But by mastering the invoicing rules and moving to monthly returns, you secure strict HMRC compliance and build a predictable, stable foundation for your scaling business.